Confused about carried interest? Relax. The insider will walk you through what it means, how it works, and why it's key to how PE firms make some serious money. Please remember to hit the like and subscribe buttons if you like the video. If you've been reading about PE, you'll probably have come across carried interest, or carry as it's generally known in the industry. It's kind of an odd term. So what is it? The key thing you need to know about carry is that it's essentially a performance fee which rewards PE firms for exceeding certain performance benchmarks on their investments or funds. It's typical in the US to run the carry calculation on an investment by investment basis, whereas in Europe, it's very normal to run it on the PE fund as a whole. That's just a little nuance before we get into it. We'll refer to funds here though, just for simplicity. How it works is quite particular though, and it very commonly operates to the 8 and 20 model. Let's explain. The 8 is the minimum performance threshold, as in 8% IRR. By the way, we cover IRR in separate videos. This varies, but 8% is really common. The fund needs to return profits to investors, and by the way, just its investors, up to this 8% IRR point, which in the industry is known as the hurdle rate. It's basically the minimum performance investors expect before the PE firm gets a cut of the profits. After the 8% hurdle, profits get split, and this is where the 20 comes in. 20% of all profits over and above the hurdle rate go to the PE firm. For a big investment or fund, that can be a serious amount of cash. So let's talk about that. Imagine $1 billion fund, and this is actually fairly small in the industry, fully invested on day one and returning $2 billion after exactly 5 years. We'll use this example for simplicity. It's not particularly realistic in terms of timing, but it's a good demonstration. That $2 billion after 5 years is roughly a 15% IRR. Now this is decent, but not exactly mind-blowing in the industry. Depending on the specifics of the carry calculation you use for this example, the PE firm takes away between $200 and $400 million. That's a payday. So we can see that this clearly works for private equity firms, but it also gets better. Carry is normally structured as a capital gain rather than simply income. And this technical distinction cuts a chunky amount off the tax paid on the proceeds. For example, in the UK, capital gains tax is 18%. The highest rate income tax is 45%. On your 300 million, the benefit of that is pretty clear. But here's the thing. Despite that sounding like a huge portion of the profits, at the end of the day, investors are familiar with how the carry structure works. And you know what? They're willing to pay the premium to access the potentially big returns private equity offers. We hope that was a useful rundown on carry. Please remember to like the video or subscribe to the channel if you found this useful.